Hey everybody, it's John King. It is Friday, the 16th of September. I have a big market update report for you today, so tune in to the end. I'm going to start by talking about specifically what's going on with the market, what I see happening with interest rates. My outlook has shifted a little bit. This week has been very concerning. But the second thing I want to talk about that's at the latter half of this video is why buy a home in general, and specifically wealth building, and how much benefit you get over time building wealth through real estate. So I'm going to talk about both of those things. Stick around. This is a really good one. You want to hear all of this. So I'm going to start by looking at where we are right now with interest rates. What you're looking at right now is a chart going back to, 1970. And we see interest rates at 7%, and they shot way up, and they shot way up, and they shot way up. And in that decade, we had rates go up by 10%. These are mortgage rates. This is literally what a mortgage rate did. So if you looked at this chart, what we're seeing here is in the 1970s, we saw interest rates go from 7% for mortgages to 17% in a 10-year time frame. That's what people are worried about, and that was caused by roaring inflation and recession at the same time. And it didn't get solved until the early 80s when the Reagan administration said, we are going to put everything into raising the interest rates so much, so fast that we're going to squash inflation. And as soon as inflation gets squashed, interest rates started coming back down. And if I go back and show you again what I was just showing you, you'll see that in the 70s, early 80s, interest rates started dropping pretty significantly. And we've been on a downward trend the entire time until we hit 2013. And then we were kind of flat between 2013 and 2020 until we hit another downward trend because of COVID, and rates went down significantly. So I'm going to zoom in a little bit here, and I'm going to show you kind of looking from, this is from basically 2000. We see interest rates coming down in the 2000s, coming down until we hit 2013. And from this time on, we saw flat interest rates, up some, down some, up some, down some. But they went down a lot. And now in 2022, they're skyrocketing. So we hit the lowest. Technically, our lowest was December of 2020. We touched that again almost in July of 2021. But if I zoom in further here, what you're really going to see is you're going to see what interest rates have been doing since 2013 being flat. And then we see this drop and we see this major rise again. But it's the most recent rate rise that has me the most concerned. This is basically looking at 2020 to right now. I thought we were going to hit the highest peak rates right here in June. And I actually started talking over the last couple of months about, hey, I think we've seen the worst behind us because we kind of hit a peak and now we're coming back down, and we've been continuing to move back down. But inflation has continued to surprise the markets. Now, to be perfectly clear, I firmly believe that inflation will, as long as the Fed stays on track and they continue to pound on inflation by raising the federal prime rate, the Federal Reserve federal funds rate is going to go up again next week. We're going to see likely a 0.75% rise. That is going to hurt you on home equity loans and lines of credit. It's going to hurt you on your credit cards, but it's going to help cure the problem we're up against. And the problem is inflation. But here's the bigger deal. Inflation is becoming a real worrisome thing. It's impacting us everywhere, and it's driving mortgage rates up even more. And then the last week, we had an inflation report this last Tuesday that surprised the market, being even bigger than what they thought it was going to be. Those are the surprises that I'm worried about. I've talked about volatility. I've talked about I see rates coming down in the next 1 to 2 years. I still see rates coming down in the next 1 to 2 years, because in every single recession in the past, and I'm going to show you this again, in every single recession in the past, we've seen mortgage rates lower at the end of the recession than they were at the beginning. And I'm going to spread this chart back out. These gray bars are recessions. Okay, so a recession started here in 1973, and timing on this thing, we were about flat when they started versus when it ends. But here, recession started, it ended lower. Recession started here, right here, recession started, and rates were down by the time they ended. Rates dropped on every single one of these recessions. I guess here was where they were flat. But rates have dropped on every recession from the start of the recession to the end, but it's volatile in between. So rates are lower at the end of recessions. Even the recession we saw very short in 2020, we saw rates end. They started here. They ended the recession down here. So they were even lower at the end of the recession. So that's critical to understand that We will see lower rates, in my opinion, lower than where we're at today. But we're square in the middle of the 6% range. And it was a very fast rise in the last week. Very fast rise. I quoted people last Friday, 5.6%. They called me back today and the exact same rate is at 6.5%. That rivals one of the largest and fastest interest rate increases that I remember seeing all year. It was a very volatile week. The market reacted strong. And that's what's got me a little more concerned about where interest rates are going to be in the near term, as we have a lot of volatility heading into the end of this year and the beginning of next year. We're going to see a lot of volatility. For people who are needing to buy a home with little down payment, or they have to have a home to sell, it's a great time. But here's the truth. These higher interest rates are going to make it even harder for people to afford the payment and harder for people to qualify. And so if you're a seller, take that to heart. I think the increase in interest rates we saw in the last week are going to really start impacting even more buyers. We saw it earlier this year when interest rates were shooting up and buyers would say, you know what, I'm out. I just can't do it. The truth is, if you don't buy, you're going to have to rent, and rents keep going up too. But it's just psychological, it's emotional, it's not logical. Logically speaking, you're better off being a homeowner. And let me explain to you why you're better off being a homeowner. So let me pull up a different chart here. And here we go. All right, so I'll share this one. Wealth building through homeownership is a very misunderstood issue. And it's something that I think people need to really grasp, because it's not about timing the market, whether the market's up or the market's down. It's about time in the market. And this chart explains that. So I'm going to give you a basic example here. This is per $100,000 of purchase price. So a couple of assumptions that I'm using here as far as interest rates, monthly payment, there's mortgage insurance. Obviously, you don't always have mortgage insurance, but there's 3 benefits you get in owning a home. 3 wealth building benefits. The first wealth building benefit is that you get tax savings. What this is showing you is $147 a month per $100,000 of purchase price, based on these scenarios, that you're getting an additional tax savings. That means $150 a month over a year's period is $1,800 a year. You can choose to just let that money roll over into a bigger tax refund at the end of the year, and now you got $1,800 to buy airline tickets to Hawaii. Or you can choose to change your withholdings, talk to your tax preparer about that, and you can see more money in every single paycheck so you can afford to write a larger check to pay for these higher monthly payments. But you're getting $150 a month per $100,000. So in this scenario, if you're buying a $300,000 home, you're getting almost $350 a month in tax savings alone. The second way that you see a huge amount of wealth building is through forced appreciation. So forced appreciation, forced savings. Forced savings is you saving money just the same as you would save money in your 401k. 401k is one of the best forced savings accounts because you don't pay any attention to it. The money goes there automatically, and it's very, very hard to get to. But a mortgage is even harder to get to. Every time you make a mortgage payment, a portion of that payment pays down the principal. That lower principal means when you sell the house, you get that much more equity out of the home when you sell it. So every single month when you're making a payment, you're putting money into your own pocket through paying down your principal, yet the value of the home typically is appreciating. I'll talk about appreciation in a moment. But that forced savings is almost another $150 a month per $100,000 of loan amount. So now you're paying down, if you bought a $300,000 home, you've got almost $450 a month of forced savings. For some people, the only way they can afford to make the payment in these crazy rates right now is by decreasing how much money they're putting away into other savings accounts. But if you were right now saving $500 a month into your 401k, and you said, hey, if I bought a $300,000 home, I'm going to get $500 a month in forced savings into paying equity, paying down the balance and gaining equity on my home, then maybe I trade those off for a short period of time. Until I can refinance and get a lower interest rate and a lower payment, maybe I decrease or stop putting money into the 401k. Because a 401k only grows based on how much money you put in there. So if you put $1,000 in there a year and it goes up by 10%, you made $100. But if you buy a home, you're only investing $10, $20, $30,000 of your money, yet the appreciation is based on the purchase price of the home. And that's what I'm going to get into right now is the appreciation. So if you didn't put money into your 401k and instead you switched it over to paying extra to afford a home in today's environment, you're picking up this appreciation. Average appreciation nationwide is 3% per year. In California, it's closer to 5 or 6% on average. But here's the thing you have to understand about average appreciation. It's just that, it's average. So when you have high years like we've had over the last few years where we've increased by 30% in a year, there are going to be low or negative years to make up for that. And you were saying, well, gosh, John, I don't want to buy when we're in one of the low years. But it's about how long you stay in the markets. There's never been a 10-year period where housing prices are lower. If you Googled average median home price in the United States and you look back the last 50 years, you can pick any point in time and 10 years later, prices are higher or the same. The only time they were the same was from 2007 to 2017. Every other time prices have been higher over any 10-year period. So buying a home and having this appreciation, you're going to appreciate on average 3%, which on $100,000 is $3,000 a year. That means that for every $100,000 on average of a home you buy, you're making $250 a month in appreciation over time. And that appreciation is tax-free. You put money into your 401k, you pay taxes on it when it comes out. You put money into a mortgage, you buy a home. When you sell that home, assuming IRS doesn't change the rules, and who knows what they're going to do, but there's a lot of people that would fight to stop this rule from changing. Based on current IRS guidelines, you can make $250,000 in appreciation, in growth, in gain on your primary home if you're a single person and pay no taxes on it at all. You can make $500,000 in appreciation, in growth, in gain on a home if you're a married couple and pay no taxes on it at all. There is no other investment that gives you this much benefit. So when you're worried about today and saying, how do I afford this monthly payment? Is buying a home really a good idea? Should I be doing this? Remember the 3 things that make a significant difference that save you about $540 a month. They earn you is a better way to say it. You are building wealth for every $100,000. What I just showed you demonstrated that for every $100,000 of home you're buying, you're building wealth at the rate of $539 a month based upon the assumptions that I made. That's over $6,000 a year. In 10 years, you've made $60,000 between tax savings, between forced savings, and average appreciation. So I believe homeownership is a valuable tool because you've got to live somewhere. You're either paying your own mortgage and getting all these benefits yourself, or you're paying somebody else's mortgage and they're getting all the benefits. So if you have questions about how any of these things work, please give me a call. Understand these are samples. Consult your tax advisor for specific advice. And I look forward to being here to guide you down the road. Thanks so much and have a wonderful day. Bye-bye.